Hi everyone, I'm Jeremy.
And I'm the other guy.
Welcome to the Suburb Data Podcast, where we cover everything from property investing to expert busting.
If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. And today, negative gearing is the hot topic. Jeremy?
Are we going with that?
We're going with it. Negative gearing. It's a hot topic at the moment. So it's been in the headlines lately, and I thought it'd be a great time for us to review negative gearing. So it could be a bit basic for maybe a lot of investors, but it's good to have an episode on this, I believe. But we won't spend too much time explaining what negative gearing is, but we will give a quick rundown and give our thoughts and ideas on
Far
it.
away.
All right. So let's have a look what's been in the media. So on the screen, let's have a look. So top stories at the moment. So 22 hours ago, a day ago, 2 days ago, negative gearing changes. So it's been in the headlines. And similar story back before the 2019 election where Labor lost the unlosable election.
Yeah, and that's when they were promising. I think they were promising to abolish negative gearing.
They were, correct. Or that was the idea. And I think for new properties, it was going to actually stay in. So if you're purchasing an established property, they were going to look to potentially remove that. But let's just start. What is negative gearing for
what is it? Back
investors?
up a bit.
Yeah, for investors that don't know what negative gearing is.
All right, well, yeah, in summary, it's when your investment runs at a cash flow loss.
So as an example on the screen, if we have a look, so we've got, let's say we had rent of, let's say, $30,000 and our total expenses for holding that investment property costed us $35,000 in the year. There's a $5,000 net loss. So we have to try and find roughly maybe close to $100 a week to fund this investment property that we've purchased. So out of our lifestyle, we need to try and find that. And there's a lot of advocates out there for cash flow property, but that's actually quite difficult in this market with rates being so high. Different story when the rates were 3%, it was a lot easier. But now that, interest-only investment loans, maybe 6.5%, 6.6%, 6.7%, it is sort of hurting the back pocket of investors. But negative gearing isn't just for investment properties.
Yeah, that's right. It's a general sort of tax law that if you are running a business, if you are investing in any income-producing asset, that you can claim losses, expenses. So in the case of real estate, we've got rather obvious expenses, your mortgage interest. You've got the property manager, insurance, council rates, repairs and maintenance, all that sort of stuff. Maybe even, that'll do. But let's say you are running an ice cream shop. You'll have expenses for that as well, and you claim those as losses against the income that you get from selling ice cream. But you'd expect that to be profitable. So you've got positive cash flow. But in the case of real estate, you might have an investor who they have their 9 to 5 income against which they can claim losses. So they can theoretically own a property which has cash flow losses, and that's called negative gearing.
And we'll move that to the next slide. But like that business example that you use, typically when you're starting out your business, you need to inject a lot of cash because there's no revenue coming in. So you need to put your own money into the business first, and you might not be able to see profits for the first couple of years, potentially. So you pay yourself back first, and then eventually once you start getting into that profit territory, you can either distribute that income or those profits to yourself or put it back within the business. So that's where losses sort of get carried forward there, don't they?
Yeah. But I think the key point here is that this is not just – we always talk about negative gearing with respect to property investment, but the concept is available across all of Australian federal tax. It doesn't matter whether you're a property investor, a share investor, a venture capitalist, or any of the other things. This is a general rule. It's not there just to pump up the property sector. It's a general tax law, and there's plenty of other countries around the world that have something similar.
Well, it was introduced back in 1936, and it was removed between 85 and 87 due to concerns over the effect, I guess, on the rental market, especially around Sydney and Perth at the time. But it was only there. It only happened for 2 years, 3 years, and it was
and
abolished.
Then it was repealed.
Yeah, it was back in. So I do clearly I do clearly remember there were certain suburbs around that election time. The company where I worked previously, a buyer's agency firm, the leads definitely dropped off a cliff because it was in the media and everyone was concerned. Yeah, because the thing is, okay, if the negative gearing benefits aren't going to be there, I think it definitely would have slowed down the property market, maybe initially. And then when that sort of balance came back in, you'd have more people going back into property again. So,
right. Well, that's a good reflection of the impact that this sort of thing would have if the general public believe that it's a really negative thing.
And back to the losses example. So let's say that we had $5,000 in losses, but you don't get all of that money back. It's not like, oh, great, it's lost $5,000, I'm getting that back in my pocket. Let's say you earn around that $100,000. And you had $5,000 in losses, your taxable income at the end of the year when you do your tax return is reduced. So you paid a certain amount of tax from your employer. Your employer withholds tax. They pay their BAS. And then at the end of the year, you do your tax return with your accountant. And then it's like, okay, well, what other deductions have you got? Oh, you've got this, we've got our property there. And in your tax return, there'll be a little section that outlines all your income, all your expenses, any depreciation. And then what it does is it reduces your taxable income. So instead of paying tax on your $100,000, you only pay tax on the $95,000. Right. So really, you get a tax credit of $1,500, but you're still down $3,500 as an example. And I'm using a 30% tax credit basis here, which is let's just say you're on that middle tier sort of earning anywhere between that $45,000 to $135,000 in the year. You pay around 30% tax above 45.
Okay, so the example we've got a property that earns around about $30,000 in rental income, but we've got $35,000 in combined expenses, interest, insurance, council rates, all those things, repairs and maintenance, property management fees. So you're behind in cash flow by $5,000, but you could have had some capital growth, but that's not considered. So we've got minus $5,000. We claim that against our other income, our personal income of $100,000.
Correct.
And we're paying 30 cents in the dollar at that marginal tax rate, which means it reduces our taxable income to $95,000. So the saving is $1,500.
Well, the idea
in this case.
Well, the idea with property is we get that capital growth. Like an example would be you're buying a high rise somewhere, and the property's paying for itself, or because I get depreciation or I get credits or I've paid down a lot of the debt. But what you're not factoring in is you're not getting capital growth on that asset, if that makes sense. So if you're not getting any capital growth, well, is that money just better being put in a high interest savings account at 4.65% as an example? Right,
yeah. And, when we look at these sorts of figures here, in this particular case, this this $1,500 that you're better off with negative gearing. So you'd be missing out on that if negative gearing was abolished. But it's in this case small potatoes, but that might be not a typical case.
That's right. And the thing is, back in before the election in 2019, they were gonna. I think there was talk about it'd get grandfathered. So, for example, if you already have an existing portfolio, all the rules would apply. It's just if you go buy a new investment property, then that wouldn't be negatively geared, but your losses can get carried forward. So let's say, okay, I can't claim that $5,000 now. It would actually accumulate. So like let's say you've got a $5,000 loss in year one and a $5,000 loss in year two. You've got an added total of $10,000. So it keeps getting carried forward till your property becomes positive.
Right, so you get some rental increases over
you pay down your debt.
You pay down your debt, and now your property is earning you money. It's cash flow positive.
Correct.
And you can claim those losses from prior years.
So instead of, let's say you've got like a $2,000, let's say 3 years have gone past and you've got an added total of, let's say, $15,000 losses, and in year 4 you've got, let's say, $2,000 of positive cash flow. Well, you won't need to pay tax on that. It'll just be taken off that $15,000 that's being carried forward.
Now that comes down to
the bucket just gets pushed. It gets pushed back. So I think if they did look to implement it, I think that would be maybe the case back what they were thinking in 2019. Right. But I think it's just a stunt to get votes. That's my opinion. But,
they all are, yeah.
but the other examples is like maybe home office expenses. Typically there's like an hourly rate that you can claim potentially. But again, talk to your tax accountant. Things like income protection if it's done through your own name, accounting fees, dry cleaning if it's associated to work, maybe donations. And look, if you've got a share portfolio, what some investors do is they might take like an equity release from their property. Let's say their property's risen in value, and let's say they take out $50,000. They go to their broker, say, look, I want to take $50,000 out. They might buy a new car with it, or they can buy maybe build a share portfolio. And if they just buy pure index funds where dividends flow through, they can claim a portion of that loan. Okay, so not tax advice. Talk to your tax accountant about that. But there are instances where you can claim losses against
other income.
Yeah, so you can sort of leverage off taking out an equity release to invest in a share portfolio. I don't do that personally. I like to keep things a bit more simple. But yeah, just the other examples of what you can claim and can't claim if they're income producing assets.
Yeah.
All right. Back to the next point is like, okay, who gets the benefit? So I'd say, look, there's a lot of, I guess, talk out there saying property investors are destroying, I guess, people trying to buy their first home. And what's your opinion on that?
I think that certainly property investors would have contributed to the demand for property and push it up, but they just don't have the level of influence on price growth that owner-occupiers do. First of all, owner-occupiers outnumber investors 2 to 1, roughly. And secondly, historical data has shown that when an investor purchases a property, that property tends to underperform in terms of capital growth compared to a similar property in the same suburb that's owner-occupied. So owner-occupiers will purchase for lifestyle reasons. They may pay above what a property is worth in the eyes of an investor. They'll also tend to overcapitalise on their renovations. And so you find that an owner-occupied property will tend to have better capital growth than an investor-owned property. And in these markets where you have a high proportion of tenants to owner-occupiers, meaning there are more landlords that own property there, they tend to have poorer capital growth. So really what's pushed property prices up is owner-occupiers, not so much investors. Investors have contributed, but not nearly as much as what people think. But when you are struggling to purchase a property, you're going to look for scapegoats. You point your finger at anyone you can.
Look, and I don't like the media pumps it up a lot. How many articles do you see? Oh, this person's got 70 properties or 30 properties or 40. Like, it's just crazy. Like a lot of
it's not common though. That's incredibly rare.
But you see it a lot on the news saying 30 properties or social media. I've just bought my 50th property. It's like, take it easy. You don't need that many properties. There's enough for everyone. But I just say to people that are maybe struggling to try and buy their first property, like I've been there. You've been there where we had nothing and it was just sacrifice, just keep building up that surplus, just block out all the noise and just understand what you're working towards. And in Sydney especially, it's tough. Like an example would be you might need to rent in Sydney and maybe just invest somewhere else, i.e. maybe Queensland or Melbourne or Brisbane, wherever it might be. Work out what your strategy is and just slow. Work at it.
If you had been renting here we are in the latter half of 2024, but if the last few years you've been renting in Sydney and instead owned a property in Perth that you could afford because Perth was so much cheaper, you would have been getting ahead of property owners in Sydney because they would have had inferior capital growth compared to Perth. So, yeah, rent vesting is a great way to get ahead. But I'd like to make a controversial statement. I would like to say that property in Australia is not unaffordable, and I've got evidence to prove it. If property was unaffordable, meaning that people could not purchase, then you would not see price growth. In fact, If nobody could afford to buy a property, you would not see a sales transaction. It wouldn't take place. If it was unaffordable, you would see prices go backwards. But over the last 40 plus years, decade after decade, we have seen prices in Australia rise. And that is because Australians can afford to buy property and more than fair market value. If they were paying fair market value, prices would have gone sideways. Instead, they have gone up and up and up. So my point is that the data says, history says, that property in Australia for the last few decades has not been unaffordable.
And I've seen, people in their, 20s, 30s, 40s, like even single too, that have blocked out a lot of the noise and just focused on their circumstances. And, maybe they do buy that $450,000 or $500,000 property somewhere, leverage, maybe take out lender's mortgage insurance and just try and buy a set and forget property interstate somewhere. But I think it is a struggle. If you've got no family support, it's hard. It's not easy. And
it's definitely got harder.
Because if you've got support, let's say you got parents or grandparents that have they've held their property for a very long time, or they've got a big amount of superannuation, or the parents are helping, you're competing against them. And that can be really, really difficult. So it's just it's not easy, but nothing ever is.
Yeah, that's right. And there's a couple of other points on that, like the what do they call that mob in London? The Economic Intelligence Unit or something?
Yes.
And they have this report they do each year about the livability index. So although there are thousands, tens of thousands of cities around the world, they restrict their analysis to about 150, maybe 200 cities. And in those cities, their last report, I think Australia had something like 4 cities in the top 20 around the world, which in my mind means Australia's the best place in the world to live, according to that intelligence report. And I remember years ago, Melbourne was ranked number 1 in the world for about 6 years using this livability index. So to me, it makes perfect sense that Australia has expensive real estate, but it's not as expensive as New York, London, Paris, Tokyo. Why is that? Why, when it's so much better place to live, is it not the most expensive place to live? So I think that Australian real estate is actually undervalued, and I get bothered by people telling me, "Oh, nobody can afford to buy real estate in the middle of a boom. How can we be having double-digit capital growth if nobody can? Who's doing all the buying then?" So it's listening to a handful of people who cannot afford to buy, who happen to be louder than the majority of people who are just quietly going about buying real estate.
Let's move forward with it. So I'd say a lot of the benefit is a lot of maybe because a majority of investors only have one investment property. I think the stats are like 72% own one investment property. So yeah, I'd say that within that sort of 45 to 135K income bracket. But, there is a big benefit. If you're owning over that 190 mark, you're getting pretty much half of your money back on negative gearing. So, if you've got a loss of, let's say, 20,000 from your property portfolio, you're pretty much getting half of that back, which sort of helps you with your accumulation. And I can see why a lot of high-income earners would take advantage of that. It's because you're buying this property, it's growing in value, but you don't have to pay tax on that capital gain until you sell, and you might just want to hold it. So later on down the track, when you're closer to retirement or you've got a lower income, you can maybe sell down, or it just gives you a bit more flexibility, doesn't it?
Yeah.
But I'd say a lot of the investors are around that 45 to 135K mark.
I think that there are a lot of investors who get advice from perhaps their accountant, hey, why don't you buy a property
I've
if
heard
it's
that.
negatively geared, blah, blah, blah.
Clients come in and they used to say, my accountant said I've got to reduce my tax. I'm like, okay. Is that the main reason why you want to invest in property? Like, yes. Okay. Well, that's not the reason you should be investing in property.
Yeah,
At the end of the day, we invest in property so we can get our time back, have flexibility, not be reliant on an employer, but also when we hit retirement later on, it's just a part of our asset allocation. So we're not putting that pressure on, when I get older, obviously I won't get the pension. So I'll have income streams from maybe my share portfolio and then the property portfolio. So I'm funding my own retirement.
Yeah, I think it's a poor strategy to just aim for paying less tax.
That's
you
right.
should be aiming to pay more tax by earning more income.
But I can see how the government can lean on this. We're the bad guys, the investors.
That's right. They're looking for a scapegoat. They want to point their finger at some demographic to say this is the cause of the problem. But first of all, we don't have unaffordable real estate. And secondly, investors are not driving up property prices as much as owner-occupiers.
It's only unaffordable in certain locations, but it doesn't mean you have to invest in those areas.
Yeah, that's right.
So let's have a look. So 29. So this graph is New Zealand median rents for the last maybe 13, 14 years.
Okay.
And what happened over here? So they abolished negative gearing in 2019 to address housing affordability. But it looks like I think that they're going to be reinstating it. So you can see there's no real big change there, is it? Like rents kept on increasing because you'd think about it. If negative gearing did get abolished, what would happen in Australia?
Well, you would have a bunch of property investors decide against investing because it's now less attractive. That would reduce demand for property. Developers would respond to that reduced demand, backing up in their supply. With restricted supply, eventually you would see prices, particularly for rents, would go up. So I would expect that the response that the market has to an abolishment of negative gearing over the next few years would be increased rents. And actually you can see it on that chart there. Is rents the blue squiggly line, what's that, Wellington City?
Wellington City.
So when did you say, 2019?
2019.
Yeah, so if you adjust for seasonality, with your naked eye, you can see that there was definitely an increase in rents. So
it looks like they're staging it back, New Zealand. So I think there's a deduction up to 50% on interest costs. Then they're going to increase it in 2025 to 75% and then back to that 100%. So why are they bringing it back in? Why are they playing around with it?
It's usually just I saw on the news just this week in Massachusetts in the USA, there was, a few years ago, there was a young beaver found by the side of the road. It was taken into animal care, and now it's been under care for a couple of years, and there's discussion in the community about releasing it to the wild. So there's debate. Some people want it released to the wild. The carers at the moment are saying it hasn't adapted, we can't release it, and it's topical. And I saw the governor of Massachusetts in front of a camera saying, we're not going to let the beaver go out into the wild. It's not ready for it. So what they're doing there is they're just capitalising on what's topical. So right now we've got something topical, the rental crisis. So every politician is trying to leverage from that. We're going to solve the problem. We're going to help you. And usually they don't help. In fact, they can actually make things worse. But to the uninformed voter, they want to come across as helping. And this whole negative gearing debate thing, it is just a PR stunt to win votes because in the long run, it won't affect things. Here's what will happen, right? You get rents go up after you abolish negative gearing, like I mentioned, reduces demand for property. Developers respond to the reduced demand with reduced supply. With reduced supply, you get an increase in rents because vacancy rates drop, even lower than they are right now, which is ridiculous. So the rents skyrocket. Eventually, properties are commonplace positive cash flow. That brings investors back into the market. That restores demand, restores supply, and then it's just business as usual. But now we have cash flow positive properties across the country. So it doesn't really stop prices from going up. It's just a temporary vote-winning
Do you
PR
think,
stunt.
and we wouldn't know, like it's guessing here, but do you think stock on market and days on market would skyrocket, or it would just happen slowly? Because let's say you're selling your property, it's going to be on the market a lot longer because you're knocking out potentially a lot of investors. Because the way I look at it is, okay, well, I might not focus on, if I do my analysis and think, look, an investment property isn't for me, it's going to impact my cash flows too much. You shouldn't be investing in property anyway if that's the case. Maybe I'll move to shares or index funds or something else instead. Do you think that days on market could creep up nationwide? Or?
Oh, yeah. So the immediate response, like you make the announcement, this is what's going to happen, we are abolishing negative gearing. I think there would be some investors who go, nah, that's it, I'm out, and they put their property on the market. So that increases the supply momentarily. But then when you get the next phase in response to that is developers. So they wind back their development projects because of the lack of demand. That eventually leads to a lack of supply. But people haven't stopped coming to our shores. People haven't stopped having babies. People still need a roof over their head. So what happens eventually with the limited supply is there's nowhere to rent. There's less properties to buy, and so the demand creeps upwards. And of course, prices go up, rents go up, and it's just back to business as usual for the lucky country. Prices keep going up, but instead of having negatively geared properties, we've got positively geared properties. That's all it does. And it wins you an election in the meantime. So you get your term of office.
So and Australia's not alone, so we're using the New Zealand example, but also I think there's like examples of it in Canada, Germany, France, the US. So it's we're not just alone.
That's right. It's not peculiar to Australia. It's commonplace.
So I've just got an article on the screen. So in 2019, I remember this clearly, but I remember there were certain pockets. I was looking around the Sutherland Shire in Sydney, and there was a significant decrease in some property values around that time. Like I remember it was a bit of a halt. One, for the business that I used to work for before, definitely things slowed down, but also the property market slowed down because people were fearful of what was going to happen, and then Labor lost and it picked up again. It was just a small little dip in the market at the time, and I couldn't get financing, so I was spewing at the time, but it is what it is.
Yeah, another problem with analysing historical data regarding this is there simply aren't enough circumstances that we can look at.
Exactly.
So it wasn't abolished, repealed, abolished, repealed, abolished, repealed, so that we can look at it. Yeah. So any conclusions you try and draw from that 1985 to 87 circumstance, it's just a one-off.
Because if you bought at the time and they abolished negative gearing, like it's all great in hindsight, isn't it? But I always bring it back to the point that whenever you can, that's when you buy. Like again, block out all the noise. I know, especially if you haven't bought before, it's hard because you just see this, have I bought too late? You know, is property for me? I just think block that noise out and talk to a broker, get your strategy, and then buy it and forget about it. Have your property manager look after that property. That's the approach you need to take with, I believe, in property investing.
Yeah.
Don't overcomplicate
there is a lot
it.
of noise,
keep it,
like you're saying.
Keep it simple. For me personally, I'm trying to keep my life a lot more simpler, like with my investments, with everything, because at the end of the day, it's life's busy, like with the business, family, friends, whatever it might be. So just keep it simple. What is the goal as an investor, do you believe?
Yeah, I guess, well, for me personally, it was just financial security. At some point, I think, I want to retire without being dependent on my super fund manager because every 6 months they send me a letter of how much money they've lost. Dear Mr. Sheppard, here's how much we've charged you to lose your money. So I want to take responsibility for my financial situation, and that's what got me into investing.
And like with negative gearing, and I'm the same with that. I never wanted to rely on employer. Like I remember back 2015 going to my accounting job thinking this isn't for me. I felt like I was going to prison every day. Sorry for all those accountants out there, but I just didn't enjoy it. I didn't enjoy it, and podcasts really got me out of that grind and educating myself. And look, I'm not a big fan of the whole self-help stuff out there, but I think back then it helped me. And then you start learning yourself and work out what works for yourself. But I think the goal with all of this, I guess with the government, they would make, if they're not paying investors back from that negative gearing, it's going to add money back in their pocket because it stays with them, doesn't it? But, you know, they make a lot of money from stamp duty, so there's going to be a lot less turnover, I believe. Yeah,
well, that's state tax, stamp duty. Yeah.
And then you got land tax, capital gains. So I just don't think, but back with this is it really helps with your accumulation phase, I believe, negative gearing. But even if it wasn't there, it shouldn't hold you back. So
that's a good point, your accumulation phase. So over the short term, you'll have a cash flow hit if you cannot claim these losses beyond zero. Like if your property is negatively geared, if you can't claim that. But like you were saying before, it's carried forward. Rents eventually increase. So it is only a temporary measure during the accumulation phase. Yeah.
But I guess accumulation phase is maybe the hardest because maybe you're still working up, your income's still getting higher. So again, you just got to work out, is it going to impact your lifestyle in any way by buying this property?
Yeah, so I think that in summary, I mean, are we getting close to summarising?
We are,
here?
yeah. Well, we'll go to the summary shortly, but I guess if we move to, I guess, the pros and cons. So what's the pro? It's like to negative gearing. I guess it stimulates rental supply because you got more investors.
That's right, yeah, and it's the same with any business. So if you make this specific for property investors only, then the rest of the economy still just gets on with business. It's still incentivising the economy, but it is not incentivising housing.
And the anti-side of things would be, I guess, tax break. It only favours the wealthy, all these big property moguls, and I can see how that can play it when you watch the news and this person's got 30 properties. It's like, it's only benefiting them. I'm not a big fan of the whole boasting about how many properties that you've got on the whole social media, and it's just, I think it's ridiculous.
Well, yeah, I mean, like you were pointing out, 70% of property investors only have one investment property. So the people that own, 20, 30 properties are quite rare.
And they don't tell you how they got there. Like I'd over 7-8 years sitting in front of clients every day. I think it was maybe one couple close to their 60s retirement that they had maybe 10 or 11, but they're all really cheap price properties. But to get to 20, 30, 40, where's that money coming from?
That's a successful business, channeling the money into property.
So what they're doing is they're getting this business, it's showing a lot of profits with their business that then they can use that to get serviceability in their personal name or in a trust or however they want to buy, and they can buy all these properties, and then when you sit in front of them, oh, hey, I've got 30 properties. But I just don't believe a lot of it.
You want to learn how they made a successful business, not how they built their portfolio.
But I think the main thing with this is it's just you don't want to be buying for negative gearing. So to me, if it gets abolished or it doesn't matter to me, doesn't matter to you, and it shouldn't matter to the investor.
Yeah, but it's another thing, I guess, that investors need to consider. Yeah. Over the long term, it's neither here nor there. It doesn't really matter. I'm okay with the abolishment of negative gearing because I know that in the long run, it's just not going to have any dampening of the big driver of wealth creation, which is capital growth. Australia is still a fantastic place to live. It's still undervalued compared to the rest of the world, and capital growth is still the big driver of wealth creation. So all this will do is it will turn negatively geared properties into cash flow positive properties, but it will take some time for that to happen. And I really think it's just a PR stunt. But in the meantime, we're going to see rents they're going to go up. So, yeah, not very clever.
Rents in certain spots.
In general, if you knock investors out of the market, then that's going to reduce the supply of rental properties.
So where can listeners go, Jez, for more resources?
Well, if this is the sort of thing that is of interest, you can click the subscribe button and you'll get notified when we have more. And if you are interested in this, give us some feedback. So there's a like button. Yep. And if you think someone else might be interested in this, there's a share button as well. Yeah,
you can add comments in the comments section if you're listening on YouTube, or just send an email to podcast@suburbdata.com.au. And like I said, if you are finding value in what we're producing, just if you leave a review on Apple Podcast or Spotify or any of those platforms, that would really help us to help more people. But that's right, everyone. Subscribe, like, share to the world, and thanks for tuning in, and see you in the next episode. Take care and bye for now.